Just want to talk to you a little bit about LICs and what we do. So, as James said, there's been over 42 new LICs listed over the last 4 years. So the space is growing, which is great because it was pretty dormant there for quite a while. So I think at the end of February was a total combined market cap of over 31 billion. So the market or the space has seen some real growth, which is great. And we're starting to see some diversity in the funds that are being offered. So investors have a real choice. And hopefully that only gets better, particularly in the international space. We're going to see some new LICs come on board in the near future. And hopefully over the next couple of years we get quite a few, so people have a good choice in that international space, given retail investors seem to have an increasing appetite for international equity exposure. So hopefully that will help. I've been told you're all very savvy investors. So one thing I wanted to talk about was discounts and premiums, which is something obviously trading on the market. Sometimes LICs trade at a discount, sometimes they trade at a premium. So in our experience, there's 3 key factors that influence the discount and premium. One of those is performance. So those managers that consistently generate alpha or perform in the manner in which they seek to perform or set out to do, that tends to have a positive influence on discounts and premiums. The other one is a big one for retail investors, and that's the dividend stream. So those that are able to offer a relatively stable and steadily growing dividend stream, that also has a positive influence on the discounts and premiums. Those that have really volatile dividend streams, they tend to suffer from a discount perspective, and it can really blow out. We've seen companies like Westoz, due to some underperformance, they had to cut their dividend, and it's really hurt them from a discount perspective, with that expanding significantly. So that's a really important thing for retail investors. And the third thing is shareholder communication. So we find that those companies that are transparent and communicating with their shareholders on a regular basis, that has a positive influence. So, because it sort of garners or fosters some trust from investors, and that's what people are looking for in that retail space. They want to know what's going on. They want to be able to trust the person that they're investing in. So those that communicate what they're trying to do, the strategy, what's happening in the fund regularly, that tends to help the discount premium sort of landscape as well. So just moving on to, with all these new LICs coming on board, how do you decide which LIC to choose? What we look for when we're rating LICs, there's a few key factors. One of those is obviously performance. So we're looking for those companies that can consistently generate alpha. So a figure that we like to use is the average annual rolling return. So that gives us over a long period of time. So that gives us a really good idea of the consistency of the performance of a manager. And that's really important because you're paying some of these guys some pretty good fees. So you really want them to be able to generate alpha for you after those fees. So looking for managers that can deliver that is really important over a long period of time. Obviously, managers are going to have good times and bad times. That's fine. That's just the way of the markets, particularly high conviction funds. But being able to generate alpha consistently over the long term is really important for investors so that they're getting value for their money. Another important factor that I just touched on is dividends. So one of the benefits of the LIC and the company structure is that you can actually manage your dividends. Unlike in the unit trust structure where they all flow through distributions, companies you're actually able to manage your dividends. So you can actually ensure that you're having a steady dividend stream and grow that steadily over time. And that's really important. So you don't want your managers being too aggressive with the dividend growth and depleting their profit reserve, because then they'll have to cut the dividend, and that will have negative implications for the share price and most likely the discount as well. So that's an important thing. Other things that we look at are the actual manager of the fund, obviously very important. Stability of the management team is something that's quite important. It's really important for a cultural perspective as well as anything else. I mean, you want people to buy into the process and you want people to gel, I guess. It's hard to find people to buy into a strategy. To keep investment team members there for long periods of time, the longer the better. So that's important. Investment team stability is really important. You don't want too much turnover, as we've seen in some fund managers in recent times. From a structural perspective, an important area is fees. So as you know, some people will have some high fees, some people have some low fees. The externally managed LICs generally have higher fees. Whilst we recognise that some of the smaller fund managers need to charge these fees, obviously to keep themselves able to operate, it's important that they're actually delivering alpha in line with these fees. So if you're charging 2%, we need to be actually generating the alpha that justifies the 2%, because there's no point in generating value from a gross perspective and then that being wiped out from a fees. If you're an investor and you're not getting any benefit as a result of all the fees taking your upside, you may as well just invest in a passive ETF. So it's important that managers are actually charging fees that aren't actually going to take out any upside. Performance fees they're sort of a thing of the part of the environment, and we don't have any issues with performance fees as long as they align the interests of the investment team. But what we're looking for with the performance fee and performance fee hurdle is an appropriate hurdle. So there's some managers out there who will have a long-only equity portfolio and their performance hurdle will be the cash rate. In our view, that's inappropriate, that they're getting paid to outperform the cash rate for an equity portfolio. So it's really important that the performance hurdle is actually aligned to the strategy of the manager, and that's something that will benefit shareholders in the long term. The other thing that we look for, I'm just trying to think. So another important facet is to look for the manager being true to name or true to style. So if you don't want people stepping away from their investment style and their investment strategy because it's not working for a specific period of time. So you want people to believe in the investment strategy and you want them to follow that through good times and bad times. You don't want them swaying on that. So it's really important that they're true to name. If they want to deliver market returns, then that's what they should be delivering. But if they're trying to deliver X% alpha or greater than market returns, it's also important that they're actually delivering that and not underperforming for a consistent period of time. With all the IPOs, it's one of the things that generally comes along with IPOs, and there's a piece on this in our upcoming monthly newsletter, which will be released in the next couple of days, is options. So most companies or IPOs will also do an option to make up for the reduced NTA that comes with the IPO costs. So it's trying to add value for people that come in at IPO instead of waiting for it to list and buying in at the lower NTA with that into in the share price. So it's really important, or it's something that investors need to be careful and wary of for new LICs on the market. So usually these options will expire within 12 to 24 months. It's different for each of them. And it's just important to know when these options are going to expire, because there's potential for them to have a dilutionary impact on the actual share price. There's a really interesting piece, so I recommend anybody over the next couple of days that's on Livewire, go and click on it and download it if you're interested in that area, because it highlights the impact of options, and it's just an area that people need to be aware of with any new LIC that comes to the market. If there's options attached, it can have a significant impact on a shareholder's returns and the NTA of the portfolio. So just something to be wary of.